Right, we are discussing about uh, a financial statement of bank, and we have discussed lot of stuffs, including the financial statement, especially balance sheet, and what are the components, and how it differs from manufacturing organizations balance sheet and uh, bank balance sheet, and we have discussed about income statement of banks and how it differ from manufacturing firms, and what are the elements included in the income statement of banks. And also we have discussed uh, and the performance ratios, especially how to calculate performance of a bank using different types of ratios. So when we observe that it's totally different, almost different from other ratio analysis of especially manufacturing sector organizations. Now we discuss about risk, fundamental risk of bank, credit risk, liquidity risk, market risk, operational risk, capital solvency risk, legal risk, and reputational risk. So credit risk, it's mean banks normally lend loan to its customers. Sometimes the borrower is unable to settle the principal amount as well as interest to the bank. So that time the credit risk may occur. Liquidity, to run the business day by day basis, a bank should keep a certain amount of money in their hand. Sometimes the bank may run out of cash. So for example, a large depositor immediately come and withdraw the money from the bank. Sometimes they are unable to, they may have difficulties to settle that deposits. So out of money it's a short period, right? So that is liquidity risk. And market risk, so there are variations in interest rate, exchange rate, and other things. So due to that, the earnings of the bank may varies. So on that variations, there are some risk may arises, that is called market risk. And operational risk, when they run their business, inherently there are some sort of risk when they operate their business, operate their banking services. Say for example, employee strikes and fire accidents and network troubles, that kind of risk, operational risk. And capital or solvency risk, banks should have a sufficient amount of capital to face uncertainties. And the legal risk, in such there are so many amendments in ongoing in existing rules and regulations regarding financial services. So that regulations, that rules may be updated time to time based on the requirement of the country and the government. Sometimes that legal amendments, new regulations may adversely impact the bank's performance. So reputational risk, goodwill, banks should, the goodwill is the most important, one of the most important factors in earning its income, especially reputation. If the bank is having a good reputation among its customers, so the many customers will come forward to deposit money and get loan from the bank. So if sometimes there are chances to damage its reputations, it will impact on its performance. So these are the fundamental risks normally faced by the banks. So credit risk is the potential variation in the income from non-payment, right? Non-payment or delayed payment on loans and securities. 3 questions need to be addressed. So how do a bank can minimize this credit risk? So very simple. When they decide to give loan to a particular customer, particular borrower, the bank should go through a detailed analysis about their credit worthiness of the customer, the borrower. So in such point of view, so there are 3 questions need to be addressed by the bank. So what has been the loss experience? What has been the loss experience of the bank? Here, the net loss to average total loans and leases. Net loss to average total, not it means, so in the numerator here, right, net loss over average total loan and leases. So that is what it says, right? So net loss to average total loan and leases. So that is one way of answering this question. What has been the loss experience? So right, this is net loss to average total loan and leases. That's number 1. Recoveries, right? Recoveries to average total loan and leases, and recoveries to prior period losses, previous year, right? Previous year losses. And net losses by type of loans and leases, type of loans, and education loan, vehicle loan. So they analyze in that point of view. So these questions, these ratios will help to answer the first question, is what has been the loss experience. To find out the loss experience, they can use this kind of different formulas. The second question is, what amount of loss do we expect? What amount of loss? So the bank give loan to its customer. So even though, so there are some instances, some customers will not pay the interest and its principal on time, or they never repay that. So it cannot be avoided by the bank. So in that circumstances, they have to assess. So what is the possible amount of total loss? It's called what? Bad debt. So unable to recover by the bank. Bad debt. So non-current assets to total loans, right? So what's the proportion of long-term loans over total loans? And second one, total past due loan losses. So loan and leases, so including non-restructured loan and leases over gross loan and leases. So restructured. So restructure mean, so some customers are already taken 2 years loan, but due to some circumstances, the feasibility of settlement of the loan by a particular customer is not possible, right? The feasibility is very low. So therefore, the bank restructure loan into 5 years or 10 years, and they change the interest rate of the loan So this time is called restructure, loan and leases. And current and non-current plus restructure, it includes both, all, right? Current provision for loan losses over total average loan or average assets, average loan. So we can, from this equation they can find, so the provision for loan loss to average asset and average total. So the denominator may be total average total assets or average total loans. So you can choose either of these two. And the second one, loan and leases allowances, loan and lease allowances to net losses or net losses and total loans. So this is a ratio, right? Allowances, loan allowance over net loss and total loan and leases. So earning coverage of net losses. Here there are some ratios. So these are calculated to assess the credit risk of these PNC and community national banks. Here they have calculated the ratios. From that they can assess its credit risk of a particular bank. Second one, we move to the liquidity risk. So liquidity risk is the variation in the net income and market value of equity caused by banks' difficulty. So banks' difficulty in obtaining cash. So bank is facing difficulties to obtaining a liquid cash at a reasonable cost from either the sale of assets or net borrowing. So think about the instance, a large depositor visit to the bank and they wanted to withdraw the money, a big amount of money. So that times, so this is the unexpected event. It is not normally happened. So in that instances, the bank manager should make arrangement to settle the withdrawal of a particular depositor. So that time they wanted to keep amount of money. So if they don't have enough money, what they do is the bank try to sell some liquid assets in the market, or they will get loan from other banks. And at this moment, when they get fund from outside, there will be a cost. So that cost may impact on the profitability of the bank. So that kind of situation is called what? Liquidity risk. Banks can acquire liquidity in two distinct ways. So how do banks get liquidity? It means how do bank get money? So first way is by liquidation of assets, sale of assets, and second way is borrowing from other banks or somewhere else. So first one, by liquidation of assets. Here first, liquidation of assets, sale of assets. Liquidation means sale. So composition of loan and investment, maturity of loan and investments, percent of loan and investment pledged as collateral. So these things may impact, these factors may impact on when deciding the cost, when deciding the value of liquidity, right? If the bank's assets are highly liquidable assets, so then they can sell the assets at a higher price at lower transaction cost and very quick manner. So if the asset quality is very low, then the bank will face difficulties to sell the assets and get money on time. So when they analyze the liquidation of assets, these are the quality criteria. So what is the proportion of loans and investments among the total assets, and what's the maturity? Some assets mature in 5 years, 10 years. Some assets can mature 5 days or 2 days, 6 months, 9 months, like that. And some assets are already pledged to get loan or kind of mortgage, right? And so second thing is borrowing. So borrowing from external people or other branches of the same bank, or interbank transaction or intra-bank transaction. It means bank loan. So in Sri Lanka we call what's SLIBOR, Sri Lanka Interbank Offer Rate, SLIBOR, offer rate. So SLIBOR means what? When the banks are getting loan from other banks, they will charge an interest for that loan. So it's a very short term loan. So the interest rate charged on that loan is called SLIBOR, Sri Lanka Interbank Offer Rate. So here, when they considering about the borrowing, so they have to find the core deposits, the value of core deposit, volatile deposits. So core deposits mean some depositors that once they deposit money, and not usually they are withdrawing the money. So very occasionally they are depositing the money. So banks can rely on these deposits, so especially fixed deposits. So 5 years, 10 years deposits. So the customers does not have an idea to withdraw the money in the near future. So that's time that deposits coming under the core borrowing. And volatile deposits. Volatile deposit means some customers put the money into the bank today morning, and the same day morning, today evening, or after few hours or few days, the depositor withdraw the money. So this is what volatile deposits. So the managers unable to predict, unable to make a plan about their volatile deposits. So asset quality and stockholders equities. Asset quality mean what? If banks solvency mean what? The capital base is very strong, and it's a risk of liquidation. Solvency risk is low. So that time other banks may give loan at a reasonable rate. In contrast, if the bank capital is not adequate, not enough capital, then the banks has to face a large amount of money as interest cost. Right, to find the liquidity risk, there are some ratios here. Core deposit, here that's a ratio, and net loans and leases over total deposits ratios, right? Core deposits. So you can find this kind of calculation to assess the liquidity risk of the bank. And let's look at the market risk. Here, market risk mean what? The risk to the financial institutions conditions resulting from adverse movement in the market rates of prices. Here, market risk arises from the changes in interest rate, changes in foreign exchange rate, changes in equity or commodity and security prices. Here interest rate means what? The potential variability in a bank's net interest income and market value of equity due to changes in the level of market interest rate. So we already discussed in detail how the fluctuation of interest rate may impact on bank's net income. So we have discussed a lot of models to that, gap analysis and duration analysis, regression analysis. So we have done a lot of stuffs, and also we have discussed at when the company go for hedging. So that kind of stuff also we have discussed in detail in the previous sessions. Here foreign exchange rate risk. So the changes in foreign exchange rate may affect on market risk. So the foreign exchange rate risk, the risk to financial institutions conditions resulting from adverse movement in foreign exchange rates and equity, commodity and security prices. Changes in market prices, interest rate, foreign exchange rates affect the market value of equities. So how it affect equities? So the changes in interest rate or exchange rate or so whatever the things or changes in the performance of the company will directly impact on share prices in the capital market. So in that way it may affect the market value of equities. Fixed income securities, bond, treasury bond and corporate bond, bank loan, right, and foreign currency holdings. So some banks keep money, so keep US dollars in their hand or other hard currencies, and associated derivatives and other off-balance sheet contracts. Now we look at operational risk. So operational risk measure the cost of efficiency of the bank's activity. So that is expense control or productivity. Also measures whether the bank has a proper procedure and system in place. So normally happening, employees may misuse the bank's fund, bank resources, and in some cases there are excess employees and there are chances to improper management or improper internal control system to make efficiencies. So that kind of inefficiencies leads the banks to dissolve in the near future, or may it cause this inefficiency of management may cause to perform at lower. So typical ratios focus on to calculate the operational risk is so total asset per employee. How to calculate total assets per employee? Here total assets should be divided by number of employees. So then they can calculate so how much it cost per employee, and total personal expenditure, HR expenses per employee, non-interest expenses ratio. So these are the things may help to understand the operational risk. There is no meaningful way to estimate likelihood of fraud and other contingencies from published data. So when look at the annual report and other memos and other things, so it's very difficult to predict and estimate the probability of fraud. The bank's operating risk is closely related to operating policies and procedures and whether it had adequate control. So here there are some ratios as we explained. Here you can find the ratios. So from these ratios, an analyst can assess the operational risk of any banks. Capital risk. Capital risk. Capital mean what? Investment. The money invested by equity shareholders. So closely tied to asset quality and a bank's overall risk profile. So the more risk taken, the greater is the amount of capital required. That is very obvious, right? So to take more risk, so the bank should have enough capitals to face this kind of any uncertainties. Here, appropriate risk measures, including all the risk measures discussed earlier, as well as ratios measuring of number 1, tier 1 capital and total tier 1 capital and total risk based capital to risk weight assets, and equity capital to total assets, it's a ratio, dividend payout ratio, and growth rate in tier 1 capital. So these are the ways to assess the capital risk. So definition of capital. So first one, the tier 1 capital. So tier 1 capital. So tier 1 capital is the total amount of the total value of common equity, it's mean equity shares, plus non-cumulative preference stocks. So value of preference. So equity capital plus preference shares plus minority interest in unconsolidated subsidiaries, less intangible assets. So intangible assets. So it simply we can say is total equity capital minus intangible assets. So that includes tier 1 capital. Tier 1 capital includes these things. And risk-weighted assets. So different loans have its own probabilities for risk. So some assets, some loans are lower risk, some loans are at higher risk. So based on their likelihood of future risk of a particular assets, so they can assign a weight for a particular loan. So the total of risk adjusted assets, where the risk weights are based on 4 risk class of assets. So importantly, a bank's dividend policy affects its capital risk by influencing retained earnings. So it's a normal thing, you know that. So when a company issue dividend, the large amount of money will outflow from the firm. So importantly, bank's dividend policy affect its capital by influencing retained earnings. Some firms, some banks, or some companies, when they earn more income, more profit, so that profit will be reserved for the capital requirement. So some companies are not willing to distribute their dividends to their customers, rather they wanted to reinvest. So these are some ratios to calculate the capital risk ratios. Legal risk is the potential that unforeseeable contracts, lawsuits, or adverse judgment can disturb or otherwise negatively affect the operations or condition of banking organizations. So legal risk include compliance risk. Compliance risk means, so there are rules and regulations and conditions. So the bank should comply on that laws and regulations. Sometimes if the banks fails to comply that laws and regulations, the central bank or relevant authority will take decision against that bank. So that is called what? Compliance risk. Strategic risk. So it may impact on its long-term plan of a bank. The legal risk may impact the long-term plan of the banks. So general liability issues. Reputational risk. Reputational risk is the potential that negative publicity means what? The bad things, the bad name. Negative publicity regarding an institutions because the practices, whether true or not, will cause a decline in the customer base, costly litigation, or revenue reduction. So think about, so what will happen if you heard the news that a particular bank is going to bankrupt? So many people will get fear and try to withdraw their money from a bank. So it's a reputational risk. So strategies for maximizing shareholders' wealth. How to maximize the shareholders' wealth? You might study it in different subject. So ultimate objective of finance management is to maximize shareholders' wealth. Shareholders' wealth is represented by share price in the stock market. So how do they can increase the shareholders' wealth? Using asset management. Asset mean what? In the bank's perspective, loans and leases. So when they give loan, they have to make a proper assessment about their customers. Liquidity management. The bank should keep enough amount of cash on their hand to manage their day-to-day business operations effectively. And management of off-balance sheet activities. Off-balance sheet activities mean some activities cannot be disclosed in their balance sheet items. So for example, forward contract, the value of forward contract, the value of options, the value of derivatives cannot be disclosed in the financial statement. So that kind of items called off-balance sheet items. So they have to manage properly. And net interest margin management, credit risk management, liquidity risk management, management of non-interest expenses, so such as wages, insurances, and office rent, security charges, internet charges, network charges, so that kind of expenditures. Securities gain and loss. So normally banks are engaging in buying and selling securities. So that also should be managed. And tax management, proper income tax management should be implemented.